right, for more on the markets, our favorite bull, Thomas Hayes, founder, chairman, managing member, Great Hill Capital. Good to see you again. We have a new month, but I think we have the same problem because we're going to talk about the same problems. And I don't know if you've changed your mind on what the Fed might or might not do, but I don't think we have CPI under control. The inflation issue keeps creeping up. Are we overplaying this hand?
Well, I think we might be overplaying the pessimism a little bit, Phil. We had our normal seasonal sell-off, which happens the second 2 weeks of February historically. February is a weak month, and we had a little payback for a monster record January. But as we move into March and April, that tends towards strength, seasonal strength. Money comes back into the markets, especially in a pre-election year. The first 2 quarters of the pre-election year are the strongest 2 quarters of the 4-year presidential cycle. So I think things are going to be strong. As for inflation, I think you hit the nail on the head, is inflation is going to continue to come down as it has every single month since July. The question is the pace. So the market got a little bit spooked in February because it wasn't as fast as everyone thought. We think that's going to be a one-off. The market got spooked because retail sales were strong, the jobs report was strong, the economy was strong, and it made the market think that the Fed's going to have to do an awful lot more. And we think that the market may be overestimating what needs to be done.
So to follow on that, we saw some indications on the data in February, at least here in the U.S., that inflation is questionable. We got some data from Europe, specifically Germany, that showed that CPI was ticking up, apparently. Now we have this China factory numbers, which is, all systems go. And if we're trying to slow the global economy down with these all firing on all cylinders, that can't be a good scenario if you're looking for a slowdown in the global economy.
Yeah, well, one of the biggest factors of U.S. CPI, Phil, is owner's equivalent rent. And if you look at new leases, commercial and residential versus existing leases, they're coming down materially, and that's going to really be seen aggressively in the numbers in May, June, and July. And that extremely heavy-weighted component of CPI is going to start to show on that lag basis in May, June, and July. So I think we just have to bide our time. If it moves down slowly like it did in February or quicker than expected, it's kind of immaterial. We have the jobs report coming out next Friday on the 10th. Then we have CPI on Tuesday, the 14th, before the Fed meets on the 22nd. But everyone knows, and it's priced in the market, we've got at least 2 more 25 basis point hikes, maybe a third, but the market seems to be bearing it pretty well. The 10-year hit 4% today, and equities basically shrugged it off.
I was going to mention that, and I have to. We're looking at the 10-year pretty closely because so many things in terms of long-term investments are tied to the 10-year, specifically home and home construction. That number, why is the 10-year at 4%? I mean, it's peaked up, and half the market thinks we're going into recession. The other half think it's all systems go. Somebody's got to give. Either the Fed is right or the markets are right. They can't both be right under the current scenario.
Well, look, you've got the economy strong and you have a fear of Fed keeping its pedal to the metal. But the Fed is going to be crimped, especially as you have this standoff on the debt ceiling, because the interest expense is becoming too high. So 3% is going to become the new percent. They're going to continue to pin long-term expectations to 2% because they don't want the consumer to change their behavior and start buying aggressively because prices are going out of control. So they'll keep talking 2%, but the real goal has to be 3%. Why? Because our only way out of 120% debt to GDP is to run inflation above trend for 3 to 5 years like we did post-World War II, the last time we were at 120% debt to GDP. By following that playbook, they brought debt to GDP down to 63% within a handful of years. And if they follow that playbook now, let inflation run a little hotter than expected, keep managing long-term expectations down, I think we're going to bring debt to GDP down, and I think the economy is going to continue to hum.
I don't want to get too technical here, but the valuations, the S&P 500 somewhere between 17 and 18 times forward, depending on who you talk to or which numbers you take. I've got some experts that have told me that they should be closer to 12, 13, which would imply a drop in the markets of 25%. And I'm the bull like you. I try to argue, well, wait a minute, there's cash on the sidelines, things are getting better, things aren't that bad, yada, yada. What is a reasonable valuation to pay in this market? And when I mean reasonable to pay, you want to pay it because you still want to give yourself some upside, right? So it's not full valuations that you're looking for. And then where are we supposed to make some money this month?
Well, we're basically trading where your bearish friends are suggesting. If you back out the top 4 or 5 weights of the S&P 500, the multiple comes down another 2 turns. If you look at 2024 earnings, you're basically looking at 15.8 times 2024. So look, we had our big correction. People are waiting for the storm that already passed. We corrected 25% last year in anticipation of the slowdown that we're seeing this year, and we're going to start to rally in anticipation of the economic earnings recovery in 2024 with S&P earnings at 250. I've got a boring company for you that got some really good news. I know you like picks, Phil, so we're going to go with 3M today. First off, number one, stick with your Alibaba. This will probably be the last time you have a chance to ever buy it below $100. So that goes without saying. But in terms of the U.S., we've got a sleepy company called 3M. They got some good news that the Department of Defense said that 90% of the earplug lawsuit plaintiffs had normal hearing, which has been a legal overhang on the stock. The stock is trading at 11.5 times forward earnings compared to its historic multiple of 17 times. You get a 5.5% dividend while you wait. And it's even lower than its great financial crisis multiple of 14 times. So we like this business. 4 components: industrial, transport, healthcare, and consumer. We think that this is going to get a re-rating as some of the legal overhang comes out, and as they do a couple tax-free spins to unlock value for the shareholder.
There is nothing wrong with boring, and I'm happy to get paid to wait. Thomas, always good to see you, my friend. Thank you.
Thanks, Bill. Appreciate it.